Given the fact that we were not able to go through problem 14.6 in the classroom, what I thought I would do is put together a short video that describes the problem and goes through several of the issues that we need to contend with. So what you'll see in on the left side of the screen is all of the transactions. What you see over here is the solution. So what I'm going to be doing is to walk through the problem and identify certain issues related to the solution that you need to be aware of. Okay? And the point that we want to make here is the fact that there are some nuances related to this problem that become somewhat complicated and a little bit different than what we've talked about before in terms of accrued interest. In any event, what we see here is that bonds payable have a par value of $900,000, which are dated January 1st, 2014, and sold at 106. So they're sold at a 6% premium. 6% times $900,000 is $54,000. So that's going to be the premium. The complicating factor is that this bond was issued on May 1st. So as we've gone through the slides, what we see is that we want to credit interest expense in this transaction, and this credit to interest expense will ultimately reduce the total interest expense for the period. Now you notice, and again, because we're not using the expected interest rate, or the effective interest rate, is what it states is that we use the interest expense account for accrued interest. So what that means is that we debit interest expense based upon cash, and then we're going to credit interest expense based upon the premium. And we'll explain that as we go forward. So in the first transaction, as we've talked about in the slides, is the cash that we receive is the 106 times the par value plus any accrued interest. So the accrued interest is $36,000, as you see right here, and this is a credit. Now, how do we get $36,000? Well, what we're looking at here is we're looking at the $900,000, which is the par value. We're multiplying this by the 12% interest rate, and this is the nominal interest rate, and then we're only accounting for these 4 months, so January through the end of April. So that number, that calculation, gives us the $36,000. So the simple transaction is going to be May 1st. So we have a debit to cash. The cash is $990,000, which includes the bond payable, the interest, the accrued interest expense, and then finally the premium on bond payable. Okay, in December 31st, 2014, we have 2 transactions. And I just want you to look at the titles, and then we'll talk about the actual journal entries. Okay, so the titles essentially is that we have interest expense and interest payable. And the reason it's interest payable is because the interest is paid January 1st. So we're accruing the interest. Now, as opposed to the effective interest rate, what we have is we have the separate transaction for the premium. So the debit is going to be the premium, and the credit is going to be interest expense, and thus this reduces interest expense. The really hard part to understand related to this problem is how we get the numbers. So how do we get $3,724? Well, let's go through this. And what you see here, and I want you to look at this transaction right here, and we're going to decipher what it is that we're talking about. Okay, so what we're saying in terms of interest expense, from an expense perspective that ultimately relates to the financial statements, we're really only looking at the period in which the bond has been issued. Well, let's just kind of look through this. And what we do in this first calculation, or in this bottom calculation, is we identify how many months the bond has been or will be ultimately issued for. And it ultimately is 116 months. Well, how do we get 116 months? Well, there's 12 months in a year. The term of the bond is 10 years, And then we subtract 4. And why do we subtract 4? Well, we subtract 4 because what we're looking at is we're looking at the fact that the bond was issued on May 1st as opposed to the beginning of the year. So what we're saying is that there are 116 active months related to the interest expense. Okay, so December 31st, 2014, let's look at this. There are 8 months that we're concerned with, and these 8 months that we're concerned with is where we're going to accrue the premium. Okay, so ultimately the premium, and the premium is the piece that is the that essentially is the equalizer related to the interest expense to get the interest expense to conform to the effective interest rate, is we have the premium that we identified earlier, which is $54,000. And then for 2014, we have 8 months of this premium. But the issue becomes is that we're actually dividing the premium by 116 months. And again, where do we get the 116 months from? We get the 116 months from the fact that the premium is allocated over the effective life of the bond, not from day one. So again, it became effective as an interest expense or as a liability on May 1st. So there are 4 months that we need to exclude from the interest expense. So this month is 116 as opposed to if we had issued it at the beginning of the year, 120. So that's where we get the 116. I think once you understand that, everything else essentially is going to flow through appropriately. Okay, so based upon this, we have the interest expense. And again, the interest expense is going to be the credit because we have a premium, the credit then reduces the total interest expense. So what we have is we have the credit for $3,724, and we are amortizing the premium for year end of $3,724. Okay, so again, the first date, May 1st, we issue the bond, and we're issuing the bond in the interim period between dates. And what we end up with is we end up with a credit to the interest expense. Now, at year end, what we really want to do is equalize everything so that the interest expense for year end of December 31st relates to the fact that we have a 10-year bond. It's actually, in this case, it's a 9-year, 8-month bond that begins on May 1st. So if you look at, and you can go through this calculation, we have a credit to interest expense here, we have a debit to interest expense here, and then we have another credit to interest expense here. These items put together essentially will create a debit, and a debit to interest expense, which is an income statement item. Debits are expenses, relates to the fact that we have this bond that's open on May 1st, and we have the interest from May 1st to the end of the year. Okay, now January 1st is pretty easy. Essentially, what we're doing here is we reverse the interest payable, and that's 108, and then we actually pay the interest of $108,000. Okay, let's look at the April 1st transaction and see if we can understand this, okay? So let's go back to the slide here. And April 1st, bonds with a par value of $360,000 are called at 102 plus accrued interest. So the key is plus accrued interest. So this is the par value, and the par value is a percentage. We're actually comparing these two numbers here. So 360 and $900,000. And if you actually look at the calculations here, what we're saying is that $360,000 represents 40% of the bond. So we actually called 40% of the bond. A student asked the question, well, why would you call a bond? Why would you bring a bond back? And generally speaking, this is because interest rates have dropped, and even though there's a premium to extinguish the bond, is the total interest is going to be reduced because possibly interest rates have dropped. Okay? So what we have is we have called 40% of the bond, and we've called this bond at 102 plus accrued interest, and we've redeemed it. So let's look at this transaction and then we'll explain it. Okay? So bond payable should be an easy transaction. So we are redeeming 40% of the bond, which is $360,000. So let's go through the other transactions. We have interest expense, and the interest expense is the interest for this 40% of the bond between January 1st and April 1st of 2015. We are going to eliminate the premium on the bond premium. In this case, we actually do have a gain. The gain is going to be a credit, and then we are extinguishing the bond, and we're extinguishing the bond of the 102 plus the accrued interest. So let's look at this transaction and make sure that we understand where each of these numbers are coming from. So on April 1st, what we're saying is that the reacquisition price of $378,000, which is the number that you see here, is coming from a couple of things. It's coming from the fact that we have $360,000, which is the par value, times the redemption price, which is 102. And then we have the interest. And again, the interest is the 360 times the 12%. But in fact, we're only reacquiring or extinguishing 40% of the debt. So the 378 is the cash for the interest payment for that 40% for the 4 months, or for the 3 months, excuse me, plus the par value. So that's where we're getting the 378. Now, let's look at, so we've got the par value here of $360,000. The unamortized premium, now you notice this 116. Well, we already talked about 116. This is the interest associated with the time period or the months where the bond was live. Okay? Now, so we got the $54,000, which is the original premium, times the 360 divided by $900,000. So we have basically 40% of the bond. And then what we're doing is that we are extinguishing this for 105 months. So this basically represents the period from April 1st, 2015 to the end. So the unamortized premium basically goes away. Okay, the accrued interest is pretty straightforward. It's going to be the 360 times the 12% times 3 out of the 12 months. And again, just keep in mind that when we start talking about the accrued interest in this problem, is that we basically have two counteracting transactions. The accrued interest related to the cash payment, and then the adjustment related to the premium. So let's look at this transaction on April 1st and see what we've got. So the bond payable, again, is the par value. The interest expense that we've talked about here is the 108, the accrued interest, and again, this is based upon the nominal interest as opposed to the effective interest. And again, the way this problem is doing this is that we have the other side of the interest is going to be on the premium. So the premium is $19,552. How do we get the $19,552? So what we have here, and this is this number here, is we are looking at $54,000. That's the total premium. And we're looking at 40% of this because that's how much we've redeemed. And then what we're looking at is we are redeeming 105 months. Okay? So the 105 months essentially is from that January 1st period all the way through the final completion of the bond. And it's January 1st, because what this is doing is this is essentially is accruing the interest from the beginning of the period. The gain is $12,352. The gain on the redemption that you see here is simply the calculation based upon the redemption price, the carrying value, the unamortized premium, and the accrued interest. So we have a gain. Gains are always a credit, and gains are going to flow through the income statement as a gain, is the $12,352. Okay, the final transaction is pretty easy because kind of think about this is now we're only looking at 60% of the bond because everything else has been redeemed. Okay, so on the final transaction is what we see here is we have the interest expense. So the interest expense is what's left over. Well, what's left over in terms of the par value is $540,000. That's multiplied by 12%. So that's $64,800. So we have an interest expense of $64,800. And because the payment is not made till the next day, January 1st, we have a credit to interest payable of $64,800. But again, the total interest is going to be less than that because what we need to do is we need to essentially accrue the expense associated with the premium. So the premium is a debit, the credit is going to be interest expense, and this is going to lower our total interest. So the final calculation is the interest expense, and again, keep in mind that the only thing that we have right now is 60% of the bond. Okay, so at 60% of the bond, essentially we are looking at 12 months divided by the total period, which is 116 months. And again, where did we get 116? That's the hardest point of this part of this problem. The 116 relates to the fact that that's the period where the bond is active. Okay, so it went from May 1st and then 10 years later, 9 years plus 8 months, and that gives us the 116. But we are accruing the premium based upon 12 months. But again, it's 12 months for our 60% of the bond, and the 60% of the bond is the fact that we have $540,000 of the bond left. So that's what we've got. Okay. Amortization of the 3 months of the 40% is, and so this is the 3 months, in the 3 months before the acquisition, and that's $559, and then the total premium amortized is $3,911. So I hope this helps. It's a little bit longer than what I like to do in terms of these presentations, but it should help you out in terms of understanding this, and what you see is the total solution for this problem. Okay, thanks.